We are the team Alpha Core. We are the team of four. Myself, Adarsh SD, 19M402, and I'm going to take types of cost. Ashwin Varghese Jacob, 19M502, is going to cover pricing methods. Gurumurthy V, 19M405, is going to take financial statements. And finally, Hari Prasad A, 19M906, is going to cover balance sheet. Types of cost. Cost generally denotes the amount of money that a company spends for creation process or production of any goods and to offer any services. Some of the examples are maintenance cost, scrap cost, capital cost, etc. Let us see three major important types of cost here. They are startup cost, fixed cost, and finally variable cost. Startup cost. These are non-recurring type of expenditure. Why? Because startup cost occurs only during the process of establishing a new business. Every startup differs from each other, and so their cost also vary accordingly. The costs that are involved for website development, market research, and advertisement of a new startup comes under startup cost. Fixed cost. After a business is started, one has to pay a certain amount of cost regularly. Fixed cost includes monthly rent, internet access charges, salaries for its workers, and the cost of the utility uses like gas and electricity. Fixed cost is an independent cost. It is not affected by the number of items a business produces as outlet. Variable cost. This is dependent on how much is the amount of product or service that a business sells at outlet. For example, if we buy excess raw material, we have to pay excess cost. And if a worker works for an extra shift, we have to pay him extra wage. Similarly, if we sell one more unit of our product or service, so that the variable cost also increase accordingly. Total cost. Total cost is the sum of both total fixed cost and total variable cost. Whenever the number of units produced is keep on increasing, the total fixed cost remains constant. It will not vary. However, the total variable cost will increase proportionally. The combination of both total fixed cost and total variable cost gives us total cost.
This is 99502 Ashwin, and now let us see about pricing. Pricing is the process where a business sets the price at which it sells its product and services. An organization has various options for selecting a pricing method. Prices are based on three dimensions that are cost, demand, and competition. The following are the types of pricing and are explained in the upcoming slides. Cost-based pricing. In cost-based pricing, a percentage of profit margin is added to the cost of the product to obtain the final price. It is of two types: cost plus pricing, where a fixed percentage is added to the total cost to set the final price. Markup pricing. Here a fixed amount of percentage is added to the selling price and is commonly seen in retail sellers. Demand-based pricing. Here the prices are finalized according to the demand of the product. When the demand is more, the organization prices the product higher to gain more profit. When the demand is less, the price of the product is reduced to attract the customers. This type of pricing can be seen in hospitality and travel industries. Competition-based pricing. Here the organization consider the price of the competitor's product and set the price of the product accordingly. The price may be higher or lower when compared to that of the competitors. This type of pricing is seen in aviation industry. Also, the introductory price charged by publisher of a textbook is also based on this type of pricing. Other pricing methods, value pricing. Here the organization wins loyal customers by charging low prices for high quality products. Target return pricing. Here the price of the product is fixed on the basis of expected profit. Going rate pricing. Here the price is set according to the price trends in market. Finally, transfer pricing. Here the goods and services are sold within the same organization to manage profit and loss ratio.
Myself, B. Gurumurthy, 19F405. So, what is P&L statement? So, it is a financial report that provides a summary of company revenues, expense, profit, loss over a given period of time. It also shows the company ability to generate sales, manage expense, and create profit, and is based on accounting principles that include revenue recognition, cash flow statements. Structure of P&L statement. So these are the main categories in P&L statements. First one, revenue, and then cost of goods sold, and selling, general, administrative, marketing and advertising, technology, research and development, interest expense, and then tax, and then also net income. So these are the structures of P&L statement. Purpose of P&L statements is to calculate the net operating profit or loss. So these are the some decision can be making this P&L statement. Hire any new employees, move to bigger office, how plan your taxes, current growth strategy effective in the P&L statement. Prepare a P&L statement. So how we can prepare P&L statement is to create the document using a spreadsheet tools like Excel, Google Sheet, and we have to create a small profit and loss statement template. And you can use a small business accounting software for prepare a P&L statement. Example of P&L statement. So this is one of the P&L statement report from 2014 to 2018. So we have to see first a total net revenue and then a gross profit, expense, earning before interest and tax, earnings before tax, and also finally we have to see net earnings from 2014 to 2018.
What is balance sheet? The balance sheet is one of the three fundamental financial statements and the key is to both financial modeling and accounting. Reports a company's assets, liabilities, and shareholders' equity at specified net time and provides a basis for company rates of return and evaluating its capital structure. It can also be referred to as a statement of net worth or a statement of financial position. Formula used for balance sheet. The balance sheet attests to the following accounting equation where assets on one side and liabilities plus shareholders equity on the other balance out. Assets equal to liabilities plus shareholders equity. The formula is a company has to pay for all things it wants assets by either borrowing money, taking in liabilities, or taking it from investors using shareholders equity. What's on the balance sheet? A balance sheet shows what a company owns and owes and how much shareholders have invested. The balance sheet formula assets equal to liabilities plus shareholders equity. Assets are cash, inventory, properties. Liabilities are rent, wages, utilities, tax, and loans. Shareholders equity are returned earnings. A number of ratios can be derived from the balance sheet, helping investors get a sense of how healthy company is. Three components of balance sheet: assets. An asset is anything of value or sources of value that can be converted into cash. Individuals, companies, and government own assets. Liabilities. Liabilities is something a person or company owe, usually a sum of money. Liabilities are settled over that time through the transfer of economic benefits including money, goods or services. Shareholders equity show how much the owners of company have invested in the business. Balance sheet sample. The statement is a great way to analyze a company's financial position. Changes in balance sheet accounts are also used to calculate cash flow in the cash flow statement. The balance sheet is very important financial statement for a many reasons. It can be looked at one its one and in conjunction with the other statement like the income statement and cash flow statement to get a full picture of company's health.